Welcome to the 1delta podcast. Today, our guest is Anthony Broderick, a long-term crypto supporter, investor, author, and also founder. Anthony, your history in crypto is going back many years. Can you tell us a bit more about how you got into crypto and how your journey over the years looked?
Yeah, absolutely. And firstly, thank you so much for having me, Kevin. It's a pleasure to be here and to speak to you as always. And so, yeah, my journey into crypto goes back many years, starting initially with school. I got really into studying economics in my final year, so much so that I was spending quite a lot of time outside of the general curriculum researching various things to do with economics. And, I was learning about gold and Austrian economics and, all these various schools of thought. And one of my teachers, I remember him very well, a guy called Mr. Stevenson, approached me and said, I appreciate your enthusiasm and I'm impressed by what you're able to learn. But just so you're aware, a lot of what I'm teaching you does not reflect very well on the real world. And a lot of the metrics that I'm teaching you are not necessarily true. That the government in power constantly manipulates them to be able to give the illusion of success and stability, even when it isn't truly there. And he went through and listed a bunch of metrics like that. The one that I remember very clearly was that he was talking about the unemployment rate and how that's not a true reflection of the actual unemployment rate. That in the UK, if you're looking for a job for more than 2 years, I believe it is, and you are actively looking, and by any metric you are actively looking, it doesn't matter. They still discount you from the unemployment statistics. So it's not that you're unemployed, you're just no longer relevant in the statistic. And obviously, during any period of prolonged issues within the economy, people are going to be unemployed for 2 years, and those numbers are not going to be reflective of the truth. As well as that, he went through and spoke about the inflation rate and how inflation rates have been gauged very differently over the years. And, they're constantly maneuvered to try and massage the illusions of government stability and competency and everything, even to like the GDP numbers and how GDP as a metric of health of an economy is not necessarily a good one, because it was something that was derived from the post-World War II era, where countries needed to regrow and rebuild very quickly. And so it made sense for the preceding decade from the end of World War II, maybe the 2 decades. But after that, there should have been more refined metrics used, because ultimately the metrics that people are trying to optimize for create the systems that we ultimately build. And so with that understanding, I got even more radicalized in my pursuit of researching alternative economics. Originally, that took me down the direction of gold and kind of going back to a gold standard. And then through exposure to a guy called Max Kaiser, who I'm sure you know, that led me to Bitcoin. Initially, when I first stumbled across it, I thought it was interesting, but I didn't fully understand it, and I kind of passively dismissed it. It wasn't until I was in University of Edinburgh in first year, where out of a bit of a rebellious streak, my friends told me about the dark web and all of the fun things that are available on that corner of the internet. And so I went into it and started venturing around, looking around, and just kind of was amazed at this this underground world. And when I learned that was completely powered through the power of Bitcoin, that was the moment where it really clicked. There was something there that was not only theoretically censorship resistant, but was actually used in practice. And obviously, you can have your debates over the efficacy of the dark web, but just as a phenomenon, whether it be a computer science experiment or a sociological experiment, it is very interesting. And that was when I really got fascinated with cryptocurrency and Bitcoin. Obviously, at that point, it was pretty much all Bitcoin because this was back in 2014. So much so that I put a significant portion of my savings into Bitcoin. This was end of 2014, and it was quite funny actually. I told my friends that I had done that, and to their credit, they sat me down at the dining hall table that evening, and they said, "Tony, we love you, we care about you, but you have gone insane, and you are currently being scammed We need you to come back to reality, sell your Bitcoin, and we'll figure out how to like reintegrate you to society. And while I appreciated the sentiment, I said, guys, I am not selling my Bitcoin and I'm going to double down on this. And well, as well intentioned as they were, ultimately they were pretty fundamentally incorrect in that assumption. And it wasn't until I was writing my dissertation at the University of Edinburgh in 2017 that they reapproached me and said, hey, that thing that you invested in 2014 and we told you to sell, did you sell? Because at this point, it was all over the news. Even the BBC was reporting on this emergence of the technology. And I quite proudly and maybe with too much pride said, yes, I still have that Bitcoin. And they looked at me and said, congratulations on not listening to us. And so that was my initial journey. The first 2 years was pretty rough because I tried to convince over those 2 years probably 200 of my close friends and acquaintances. And when I say convinced, I mean like I really tried to. I was a bit religious about it, maybe too much so. And I honestly, hand on heart, I think out of those 200 people, literally zero of them had bought Bitcoin. And so from there, it didn't change my mind. I continued to double down. And as I mentioned, I wrote my dissertation at Edinburgh on Bitcoin, trying to answer the question, is Bitcoin money? So I wrote an 18,000 word dissertation on that question. After I had submitted it, I was approached by an academic publishers and they wanted to sell it online as a book. And so that's when I agreed to the terms of the contract. They paperback printed it and sold it on Amazon. I'm not going to claim it was some resounding success where I made lots of money from it. But a few copies were sold and it was just quite cool to see that available, which it still is today. And from there, that kind of started my journey into crypto professionally. So we can get into that a little bit later. But yeah, that was how it all started.
Yeah, I remember very well the times. I've been quite active in 2014 and 15 and 16. So yeah, first of all, it's an amazing contribution in the early days to like trying to convince sort of the first people to join, because I think back then it was really onboarding people one by one, showing them how and where you can purchase Bitcoin. And I understand it wasn't too successful. I mean, it was probably the most desperate years in the last 10 years of crypto. Probably many of them changed their mind in 2017. But yeah, I understand the struggles trying to convince anyone in 2015 to buy into Bitcoin. Yeah, the interesting part that you mentioned is that I mean, the economic theory. I always felt like economics is more an art than a science, and it looks like there is a lot of drift in how we sort of explain phenomena in the real world. Are there any particular gaps that you want to highlight in these theories, or that you sort of figured out, okay, this is what is different and something you want to particularly highlight?
In terms of the economic theories themselves, the problem I find is that these are very mathematized subjects. And so when you try to go deep into them, you have to have some level of deep mathematical foundations. And so I never was able to go deep inside the econometrics of the Keynesian school of thought, which was what a lot of my friends studying economics in Edinburgh were required to do. I did obviously dive into the high level differences between Keynesian, Hayekian, and Austrian economics. I would say the one thing that I was most radicalized by was this understanding of hard money, and that you can only print money for a certain period of time before the whole system necessarily has to collapse, in the sense that it wasn't a misunderstanding or misdiagnosis of a theory, but it was more of a math problem in its fundamentals. So if you start looking at fiat currency in those terms, where there is a point whereby the debt fueled system can no longer be fueled by that debt, and that there is no way out except default, then the question is not if collapse, but when collapse. And again, there's so many variables as to the supply and demands of currency, which in the current form is debt. Like currency is debt in the current incarnation. But yeah, it was the thing that I was radicalized by was this idea of hard money. And I'm not averse to gold. I think that it's an interesting proposition. I have a very small amount of gold, like a little coin, and I'm fascinated by it on a very chimp level. But I still think that when you're looking at civilization, you have to be looking at global coordination, opt-in systems that are censorship resistant and that can have security as its most fundamental presupposition. And assuming that civilization will last as long as the internet, it always just made more sense to me to invest in Bitcoin, not necessarily even financially, just in my own intellectual resources and energy. And like going back to those early days of Bitcoin, like in 2014, I said that I put a lot of my savings into Bitcoin, which I did, but unfortunately I didn't actually have very much savings, so it's not as impressive as it might have sounded. But back then, this was just after the bubble had burst in like 2013, 2014. And back then I was truly making a political statement as opposed to an investment decision. I thought there was a very long tail chance that this is going to turn into significant amounts of money. But I've been researching enough about economics and politics to understand the depth of the corruption of the systems which I was embedded in. And you can go out and you can protest and you can wave a flag or call names or do things online. But the question is that really systemic change, or is it going to be superficial change that makes you feel better about your own place in the world? Now, I'm not saying that you shouldn't do that, but like the optimal option is to do systemic reform where you can on the level of incentive structures, on the level of actual infrastructure. And if you want to do political statements to raise awareness and be able to meme things into the world, then of course you should. So yeah, back then it was much more of a political statement than anything. And for 2.5 years, it was remaining a political statement until one day, suddenly the price started to actually go up. And, then the political statement turned into a very solid financial decision. But again, like the probabilities that I laid out were that this was more of just an investment in the future, something that I could prove to myself that I wasn't just talking about something because it was interesting and I liked the ascribing my name and my ego to some movement, but actually financially investing myself really proved to be valuable and a reflection of my conviction.
It's interesting that you I've seen that many people who were hardcore in the early days when it comes to Bitcoin and so strongly believe that this is going to be the future. Honestly, for me, even back then running one of the first businesses at least in Switzerland with a crypto exchange, it still felt like somehow that might not be the future that or at least Bitcoin maxis claim. And do you think, like looking back, that you made the decision sort of that this is going to be the future based on the right premises? Because in hindsight, a lot of the dynamics behind Bitcoin turned out to be things like illicit activity. It has to be mentioned in the early days, including also ransomware at some point, and that was slowly only transitioning into a system that is being used for non-illicit activities. What was the thing that sort of convinced you, like back then, that this must be it? And it's a big decision to put all your money into something like Bitcoin that is as unproven as it was in 2014.
Yeah, I agree that some of the assumptions I'd made back then, whether it was just in my own philosophy or even a little bit later on, things that I wrote in my thesis, have not actually borne out, and we can get into those in much more detail. But I would say the fundamental of having a non-sovereign financial value layer on top of the internet, which is opt-in, censorship resistant, and open source, I think that fundamental understanding of value, especially in the internet age, was a legitimate one. Now, since that period, obviously, there's been a lot of evolution in blockchain technology. We've been able to see where it is most widely relevant and where it is deficient. And so my opinions have refined greatly since that point. But I think fundamentally understanding that you need to build new systems as opposed to tear down old ones, and that this proof of concept was pointing the direction out of a very dark period for humanity. And I know people might make that sound like it's overly dramatic, but like, once you really understand the depth of the corruption within the political and economic frameworks and how the world really works, it's really just quite depressing. And in that darkness, I found that Bitcoin made me hopeful and made me optimistic. And so investing my attention and energy in that sector made sense then, and it still makes sense now, because as you may know, well, I'm sure you're aware, like right now, there's kind of this resurgence of cynicism and skepticism towards cryptocurrency. And I stand resolute in my conviction, and I'm happy to walk through why I'm still so strong in my beliefs.
Yeah, before we jump into how corrupt the world is and also a bit more in the content of the book, I mean, I completely agree that the current system has a lot of issues, and that we are building this decentralized future not because we just want to have it different, but they think it will be in the long run a necessity to replace a system that sort of has an expiry date. But you mentioned hard money and some other properties of Bitcoin. Can you maybe tell for the listeners how Bitcoin is different in that sense to the currencies we know?
Yeah, sure. So the issue that we have with the currencies that exist today is that they are issued on a debt-based model, meaning that for them to come into creation, there is a necessity for that principal to be repaid, but with future interest. Now, that interest does not actually exist in the money supply, and therefore we're on the treadmill of debt, whereby we constantly have to print more money to repay the principal plus the interest that will one day come due. And so what that means is you cannot have true independent value created for, centuries or millennia without having it tied intrinsically to future demands on repayment on again, the principal and the interest. And so there's no way off this treadmill without going to some kind of hard money. And so the model that I just described to you is known as the fiat currency system. Fiat, if you look back to ancient Greek, means power through authority, in the sense that there's no power in terms of meritocracy, there's no power in terms of democratic buy-in, it's power in its own creation. Like power is created, it is forced on you by its own default, by its own mechanisms. And so that was the system that was born coming out of the transition from basically World War II, from the pounds, when the British pound was reigning, when we transitioned from then to the US dollar becoming more prominent coming out of World War II, and the Bretton Woods Accords. That's when we transitioned from having gold-backed financial system, whereby if you wanted to print more money, you had to acquire gold first. And gold is obviously a derivative of natural processes deep in the earth. And it also has limited supply, and it requires a lot of effort and human labor to produce. And therefore, it ties the money supply to something real. That was something that the monetary system has been based on, for eons. And we transitioned from that to the fiat system, which again is fundamentally broken in the sense that you're constantly having to create more money to feed the debt cycles. And when you do that, you're constantly inflating the currency. And this is ultimately how civilizations collapse. This is something that can be seen in every civilization. If you look at the Greek or the Roman civilizations, one of the main reasons why they collapsed is that they became too indebted to either their population or maybe its other societies, civilizations around at the time. And they had to eventually start watering down their currency by tainting it with various other metals. So one example is in I believe it was the Greek period, where they had, gold and silver coins, and then suddenly they started introducing bronze into the coins themselves so that they had to acquire less of rare metals, meaning they could inflate their money supply, meaning they could go back and repay the debt. And so if you're trying to build the strongest foundation for economies that can last not decades, but centuries and millennia, you need some hard money underlying that, something that will allow value to withstand independently without having to constantly be in this cycle of debt creation and debt repayment. So they're the two systems that we've had throughout history. We tend as civilizations to move between hard money, usually backed by precious metals, to then eventually in late stage civilizations moving towards fiat, until the point where the debt becomes so burdensome that the whole system implodes. And so they're the two models that we've been oscillating between. And again, that's for all major civilizations. And what we have now is an opportunity where we can have a hard money based system, but one that is not a derivative of gold or precious metals, but is backed by a internet currency, which is the internet of value. And we can argue about what that may be, whether it be Bitcoin or Ethereum or something else. But like outside of that debate, just to appreciate that this technology offers an opportunity to get out of this flywheel, moving between two systems that have collapsed, numerous times throughout history, and be able to transact peer-to-peer, trustlessly, via an open source system that's censorship resistant and that is fully settled within seconds or within minutes. This is something that's never been an option for the species before. And it's something that I believe we should not squander to have that as a third possibility. Obviously, there are some risks in taking on a new monetary system, but I think there's great risk in keeping what we have. If you look at the rate of national debts or global debts, both on the level of governments, but also on the level of individuals and corporations, etc., we're now reaching a point where this debt-based model is coming to an end. What that end will look like, we're not sure. Will it, like as Elon says, will it go out with a whimper or will it go out with a boom? We're yet to see, but ultimately I would rather not find out. I would rather build alternative financial rails, incrementally migrate to them, take a cautious yet somewhat quick approach. Sorry, not cautious but quick, but cautious in our approach, but also aware of the impending timescale, and that we need to make this transition with as little delay as possible.
It's a typical, it sounds like a typical Bitcoiner type of view, also with regards to like the idea of a Bitcoin standard. The history of money in general is an interesting one. I think I had no idea what money even is until I got into crypto, and I never even had spent any second of my life thinking about it and questioning what makes up the value of the money I use every day. And then second, also, I think the bigger question is what is value in the first place? Critics might argue that Bitcoin doesn't have any of that intrinsic value itself. Then the big might argue that that gold doesn't have it, that most of the value of gold is not in its industrial utility. How do you see like Bitcoin as sort of having that form of intrinsic value? I mean, what is it even backed in the first place? And if you then just use Bitcoin to back other currencies, does it solve the problem? And how does it solve it differently than just socially coordinating between countries that we gonna need the gold standard? Because as far as understood, that was also why the gold standard existed post-war, that people or nations would not just like infinitely inflate their currencies.
Yeah, it's a good question. When it comes to real value, I think there's really only a few base primitives that you can say have pure intrinsic value. I would say that that's food and that's shelter, essentially, like things that directly keep you alive at the moment of consumption. I would say that that is the real economy. Everything else is abstractions above that. And the question is, how abstracted is it, and what is the quality of that layers of abstraction? And ultimately, that's what money is. Money is able to abstract across resources, be that for food or for shelter, or for other aspects of modern living. And so that's really what that comes down to. In the sense of, is gold intrinsically valuable? I think the answer is no. You can't burn it for heat, you can't eat it for food, and you can't sleep under it for shelter. So there is very little intrinsic value to what gold is. Ultimately, it's a collective hallucination, and that's what most of what the modern world is. We have the ability as human beings to think abstractly about the world. That's what differentiates us from the rest of the animal kingdom. And that's what Homo sapien even translate to back in Latin, which is thinking ape. And obviously thinking is the capacity to think abstractly. So if you look at it in those terms, we are ultimately building everything in the economy on the foundation of intrinsics, which is food and shelter. Everything else is just an abstraction layer, which can help with the better allocation of those fundamentals that are based for survival. And then obviously the other things that come on top of that for the modern world. Does Bitcoin have intrinsic value? I would say no, it doesn't. Does it have as much intrinsic value as gold? I would say yes, it does. But ultimately, Bitcoin is coming into adoption based on a meme, and that meme is the meme of hard money, but it's the meme of the internet. And what's different between gold and Bitcoin is that you don't have to trust your government or your custodian to be able to look after this thing for you. And so even if the government does end up overspending on their debts, even in a gold-backed system, they can come and they can claim your gold, because that's something that's happened even in the US in the not too distant history. Like, governments come and they claim your gold. They can never come and claim your Bitcoin. And everything is fully auditable and everything is fully usable within the general economy. So I would say that gold has no intrinsic value, but it's useful. I would say Bitcoin has no intrinsic value, but it's useful. I would say Bitcoin is arguably more useful than gold in the currency model. But it does get complicated, because when I was basing my thesis on the Bitcoin of 2017, I had some fundamental assumptions surrounding finality and block space and the Lightning Network, none of which have come to fruition. And so, do I realistically see Bitcoin as the end state for currency? I can no longer, in good faith, say that, but I think it's a admirable stage in the development of currency. I think if we were to start using it to back central banks to be able to mitigate the inflationary effects of the printing, I think if we were to use it in global trade settlement, maybe if we were to do some kind of algorithmic stablecoins backed by it or something similar, I think that would be a valuable contribution. But yeah, I'm no longer a Bitcoin maxi. I'm seeing how this technology is evolving, and I think there's much more room for innovation outside of the Bitcoin ecosystem than there is within it.
So the title of your book is Bitcoin Money. What's your answer?
No, I would say it's not money. I think it's a store of value that can be very helpful in its global settlement utility, in its backing of government currencies, to have some kind of tie to some hard asset. And if Bitcoin had a different evolutionary trajectory, if it actually did fix its scalability issues, if the Lightning Network did actually work, then I would say that yes, this is happening. But right now, and this is, I wrote that dissertation in 2017, 7 years later, no progress has been made in those regards. And so I would say, no, Bitcoin is not money, but its adoption as a store of value and as a Trojan horse for cryptocurrency, I think is a very important step forward to what will be the final state of money.
Why do you think it's a store of value? I mean, classically, as I understand, money has these three dimensions or properties, like unit of account, which is basically like the centimeter of value. But then the currency has to be the least volatile asset in the economy, which obviously Bitcoin is not and is not very good at. And then we have the medium of exchange, which always looked as the most appealing property to me when it comes to Bitcoin, except for that we never got that Lightning system to work, making Bitcoin too much of a bottleneck, because we are talking about 500,000 transactions per day as the total throughput, which is just like leading to nowhere. And then we have the store of value that has become the dominant narrative in the last 5 years and seem to do well. But why do you think it's store of value?
Yeah, I think it's a nascent store of value in the sense that all store of values had their level of maturity of adoption. Right now, the most prominent is gold, and that's widely regarded by, whether it's economists or central banks or just people in the general world as the core store of value. But gold has been very volatile throughout history. If you were one of the early adopters of gold back in the cradle of civilization, then that gold will have gone up tremendously in the long term, but would have experienced a lot of volatility in the short to medium term. I think we're at that stage with Bitcoin. And even more recently, the gold ETFs only got approved in like relatively recent years. And since then, the gold price has increased over 300% in that period. I mean, that's not a very stable, it's a store of value, sure, like value is being stored into the future, but it's obviously still very prone to external pressures and market pressures and economic pressures. And so I still think that Bitcoin, under the assumption that gold has no intrinsic value, which is something that I fundamentally believe, but it's useful in the sense that Bitcoin has no intrinsic value, but it's useful in many of the same ways. And it's useful in many more ways. It's much more adaptable and has more utility in the internet age. And if you're having it based on the same meme with a lot of the same fundamentals like limited supply, and it's hard to mine, and it's predictable in its distribution schedule, and the fact that it's all open source, and so people can review the code and make sure there's no backends or no one's going to be doing money printing. For those reasons, I think that the market cap potential is significantly bigger than gold. And like for me, I am interested in gold. Like I don't find it something that is so grotesque or so primitive as some people do in the space. I really like it, but the question is, how the hell do I verify if this is legitimate? Is this actually pure gold that I'm buying? Do I have to, I have to go drill a hole and send off the flakes to another trusted third party to verify that this is actually my gold? And what if they're plating the gold, a couple centimeters into the gold bar with something that has the same density of metal? And how the hell are you going to verify that? Do you want to be drilling an inch deep into your gold bar? It kind of detracts from the beauty of it, and maybe its resale value. And these questions around authenticity, the questions around divisibility and transportation, are something that are fundamental. These are fundamental questions and fundamental problems that can never be solved and will never be solved with gold. It is impossible for gold to overcome these issues. It is impossible. My father is very into gold. He has his little gold card called the Glint card, where he buys gold and he sends it to this safe house, and they credit it to his account. And great, that's fantastic. But again, you are trusting so many middlemen in that process that yes, it is better to have that than full exposure to fiat currency where you're being inflated away at the whims of economists. But there are so many trust assumptions in there that I think it's at least fair to consider having some diversification in your portfolio with gold and other assets that have similar values, similar properties, and similar memes, especially in the age of the internet, which is why I always recommend for people to have some level of exposure to cryptocurrency. The big ones are Bitcoin and Ethereum, both of different technological properties, but ultimately I think are aiming in similar directions. And yeah, I would leave it at that.
Yeah, I think I would agree that gold is a technology that was great not only pre-internet but in the very early days of civilization. It's there are not many elements that are as heavy as gold. I think it's basically tungsten. That so it makes it naturally like good for like you can take it in your hand. At least in the early days where you couldn't forge basically these gold bars so easily with the tungsten core. And then you have the most secure database in the world, which is basically like the database of our universe. But then I think we're also looking forward. You mentioned that Bitcoin for you is not the end of money. Personally, for me, when I look at a store of value, I mean, why don't I buy just like an index fund or any other asset that is potentially also productive and is probably a better store of value than Bitcoin, and with less volatility and looking at the S&P 500's last century's annual return around 10%, which is like amazing way to store value and even grow the value. Where do you see the future of money? But it's not in gold, it's not in Bitcoin, it's not in fiat currencies. What is it?
Yeah, so in terms of addressing the index fund point, again, I'm not a Puritan or maximalist. I think it makes sense to have some index funds in some stock markets, but as I mentioned and alluded to earlier about the debt cycle or the debt treadmill that we're caught on, the problem is at some point these debt bubbles have to pop, and they have to pop in a big way. What it looked like was going to happen in 2008 was that there was going to have to be some deep structural reform to how banking was done and to how finance is done and to how economics is implemented. And I think to a large extent what we saw was just an obfuscation. There was no deep structural reform surrounding how debt was handled, how intelligent decisions were being made, how the legal system interfaces with white collar crime all around the world, and the over financialization of the global economy. These are fundamentals. When you're putting this much emphasis in the world on finance, it means that you're hollowing out the general economy. Because if you have someone who's trying to build a productive manufacturing plant in, let's say, Liverpool in England, which is used to be a big shipping area, and they can offer investors a steady 5% return on their investment, and instead of having that as an appealing proposition, they're going to the hedge funds of the world where they're doing high frequency trading and they are doing arbitrage between the Japanese yen and the euro dollar market, whatever, and they're able to make such crazy money. Then what you're doing is you're hollowing out the economy because you're putting too much emphasis on finance and you're putting too much emphasis on fake economics. Ultimately, what we need in the modern world is we need more investment in fundamentals, in technologies, in infrastructure, in energy, real world goods and assets. And what we're missing by having all of this overemphasis on debt, on overemphasis on finance, is investment in that real economy. And what I see is a big crash coming for the stock markets when a lot of these chickens come home to roost. And so that is going to happen. And that's what you're seeing happen now, is that with the central banking model, there's really only one way to plaster over the issues without deep structural reform, and that is to create more money through various vehicles, through various names over time. One time it's quantitative easing, once, and another time it's adding liquidity to the market. It's doing stock buybacks, or it's injecting liquidity into the stock market or whatever. Like, there's so many different names that you can call this thing, but they have one tool in the toolbox, and that is print more money. And the one metric that they tend to use over the health of the economy is the stock market going up? Is the stock market going up? So that's why you see this incredible rise in the stock market over the last couple of decades. That is not through some natural law of economics. That is done through design. They are each of the heads of the Fed that come in have one mandate for themselves. I want to do good. I want to look like I am doing good. I want to look like I am a success. And they will do anything in their power to achieve that. And the only thing in their power is to add more money to the system in various ways, whether it's overtly or covertly. They will add more money to the system, add more money to the system. They will inflate the currency. They will create more debt. But at some point, that tool just doesn't work anymore. And that's now, I think, what we're starting to see. The cracks are emerging where the debt is so outrageous. The increase in the money supply is so exponential that something's going to implode. And when it does, the precious stock market will be directly affected. And that's why a lot of asset managers and a lot of governments even are starting to look at hard money assets like gold, which can potentially, at least in the medium term, can provide a safe haven. Like, if you look at the crash in 2007, obviously gold would have meant to have been a inverse relationship to the performance, so that when the stock market crashed, gold would soar up in price. What actually happened was that the stock market crashed, gold crashed with it because people are scared. They sit in cash for 3 to 6 months, and then it was after 3 to 6 months that people started investing in gold as the safe haven asset, which is when it started to appreciate. So yeah, the point being, I think that the stock market is a good place to put your money because every Fed chair in the world is constantly trying to pump up that index and that performance on the stock market, because that is how they get to label themselves a good boy and how the economists label them a good boy. But the chickens will come home to roost at some point, and it will affect the stock market very deeply. And without deep structural reform, it could be a systemic wide collapse. So I hope that isn't the case. Let's see. And let's, in the meantime, build alternative technologies which can be viable by the time that happens, so that it doesn't have to be a moment of collapse, but can be a moment of transition.
Yeah, a moment of transition. I mean, all this inflation always reminds me of Ray Dalio's latest book, where he describes rise and fall of empires, and also how inflation sort of is part of the last chapter of any falling empire, and looking at how much debt the US is adding. Like, I think it's at 1 trillion every 3 months, and it's only increasing. That this is the basically the falling empire, and it's not looking so good. That there is a transition, but also looking maybe in the broader context, like what the modern nation state is only a few hundred years old, and it seems like that this model with the central bank is so deeply part of the architecture of the modern nation state. And I'm wondering, how could a future nation look like where state and money is separated in the same way as there was a separation in many countries of state and church? Can a modern nation function? And the question is is it fundamentally part of the architecture of a nation state, or is it just convenient for the government to print more money, because it's basically you can accrue almost an infinite amount of debt and just like solve all your problems by printing more money. At least that's how the US is currently operating.
Yeah, it's a good question. Does history predict the future, in the sense that will it be a one-to-one, what has been will be? Or is it probabilistic, where you can see that history defines a certain range of possibilities And across that spectrum, there's different likelihoods of occurring. As an optimist and a technologist, I would like to choose the probabilistic route, where there will always be the temptation for government to seize control of a local currency, whereby it can have the pure dominance and it can have pure authoritarian control, because ultimately power corrupts and absolute power corrupts absolutely. And that's ultimately what you see when it comes to true centralized currencies around the world and through history. I think the government will have to be flexible. I mean, just necessarily, we need more flexibility in government to be able to adapt to the modern age. We have systems that are archaic in how they're operated, in how they're implemented. And in the age of technology, I think that that's fundamentally unacceptable. And so by having these currencies emerge as a competitive force to an old monetary framework, I think it also presents an opportunity for competition between the digital economy and how government functions more generally speaking. And will there be a convergence with nation state and blockchain technology in some very deep form, where maybe you'll one day have blockchain technology as the base layer for governance around the world? I don't know, but I would like to find out. And that's why I'm involved in this space. That's why I'm building how I am, and why I'm philosophizing as I do, is to try and find viable routes forward. But, ultimately, whilst your ambitions may be great, your competence has to be greater. You need to be able to define the least number of steps with the maximum probability of positive outcome. And then you need to make pragmatic micro decisions every day to achieve those different stages of development to ultimately take you to where you are. And right now, I think what we need to do as a space is we need to be obviously continuing our implementations of infrastructure and developing what it would mean, and having the capacity to support, whether it be transaction throughputs that could, support a global economy. But I think we also need to be investing more in these infrastructure plays in terms of governance and experiments with currency. Some people are so fed up in crypto with stablecoins or different types of money, but ultimately I think this is just how creative destruction works. And whilst there's many setbacks in the space, and there is a lot of delusion, there is a lot of chaos, and there is a lot of fraud, I think there is core technology here that we will look back on 10 years from now, and we will be able to appreciate that this was the birth of something truly brilliant. And, the birthing process is painful, it's bloody, it can be shitty, but ultimately is something that is a natural process, and is something that can really affect change in ways that are incomprehensible by the moment-to-moment human mind.
Well, I definitely agree that this technology will transform and if not even save civilization as we know it. And it took me personally almost like 10 years to really be 100% convinced that this is really addressing an issue. This is really here to stay, and it's also something that I'm willing to make my life's work to bring it into life. I joined based on the promise in 2014, doing this or transitioning full time into crypto, based on the idea that the current system, as we know it, is corrupted. And when you look at it just from a centralization aspect, it becomes very apparent that there are very centralized elements in also even our so-called democracies. Central bank already gives it away with in its name. But even looking at all the representative democracies in the world, they have a centralization aspect that can be corrupted over time. And it looks like a few hundred years later that people, especially corporations with money, figured out the way how to corrupt the system. do you think or central banks, as I understand, should be like this technocratic institution that is not making any decisions based on political influence? Because as I understand, it would be otherwise being misused by just like quantitative easing, basically boosting short-term the economy and just to have better election outcomes. What is the way how today the central bank seems to be or must be corrupted in a way that they're printing so much money, which might not be in the interest of the people?
Yeah, so there's a few things surrounding that. The first one, which jumps to my mind, is that we mentioned how the fiat system is based on debt, that we're constantly trying to repay the principal of some money that was created either through central bank printing or through government debt issuance, whatever, plus interest. But the interesting thing is about the central banking model, and the thing that I think is surprisingly simple, but also extraordinarily complex, is that it's not necessary for the central banks to create money which is bound by debt. They could create something of nothing and issue it freely, in the sense that if the government wants to access some excess supply of money that has not been collected by debt, has not been collected by tax, instead of issuing bonds that can then, or T-bills that can be then purchased by the central bank, which then creates that money into supply, creates the principal of debt, creates the interest of debt, they could just create that money and give it to the government, relinquishing the requirements for debt repayments, both on the principal and on the interest. Now, the first question that any economist or thinking person might say is, well, wouldn't that just necessarily cause hyperinflation? Because now if you've got no demands on the interests, if you've got no constraints through the debt, now you're just going to print to infinity and the whole system goes under anyway. Well, the whole system goes under through constraints and propagation of inflation in the first place. Like that's one of the fundamental principles. Like the fiat system goes to hell via inflation and via debt, right? But inflation itself is enough of a competitive force in the world whereby it would be sufficient to put necessary constraints on both government and central banking actors, in my opinion. It's that we actually could have a system, and again, I don't think this is the optimal system. I think we do need something based on hard assets with limited predictable supplies, etc. But this was, in my opinion, the biggest fraud, possibly one of the biggest frauds, if not the biggest fraud ever committed on the human species, which is that we got confused by the banking terminology. We got screwed over by this cabal of bankers. And if you think that that's an exaggeration, I recommend a book called The Monster from Jekyll Island, which talks about how the banking dynasties of the early 1900s came together to create a central bank, push through the political movement under false pretense, under false advertising. And the Monster from Jekyll Island goes through this in great length and detail. But the point is, if you're going to go into some system based in fiat, you don't have to have a debt-based version of that. You can have one that the money is just created, it's distributed, and then it can be reclaimed either through taxes or however. But that's one of the points I would mention. The other surrounding the role of central banks and what makes it so insidious is that you have something called the Cantillon effect or the Cantillon effect, depending on your pronunciation. Essentially, it means that the closer you are to the source of money creation, the more of it you will be able to benefit and the more of it you'll be able to accumulate. And in a world driven by connections and centralized institutions, what you see is that the institutional banks, the retail banks, the investment banks, the richest people in the world, because of their proximity to the central bankers who make the decisions around what will be printed and how it will be distributed. They get the money first, they buy the assets, and then everything goes up. The asset prices go up, house prices go up, stock market goes up, because these are the things that the people with the money, they want, right? And so that's such an insidious force, because you're seeing this type of inflation with regards to house prices, which is obviously such a fundamental. That's actually being driven purely based out of speculation, from the free money coming from the various central banks around the world. And there's a great and horrifying metaphor for this, which is, it's the same when it came to giving out food, the concentration camps in Nazi Germany. Like, the closer you were to the distribution point, like if you were the Jewish slave that was being forced to carry the bags of grain from the truck into the distribution yard, or you were the one that was handing it out, or whatever, you would, by necessity and by proximity, be able to access the most food most of the time, and you would have the least of the negative impacts of that distribution mechanism of that valued good. And so I think that's really what we're seeing, and we're seeing in the modern world this proliferation of inequality. You're seeing everything's going up, people are confused, house prices are astronomical, stock prices are astronomical, and people don't really understand that this is all down to how money is created and distributed. And the thing is, this is a decision that we're making. This can be made more these decisions can be made differently, but they're not being made differently. This was very intentional. And so we shouldn't be surprised when, house prices are going through the roof as they are. And even in terms of the questions of the type of central bank, because we talk about central bank as if it's a static entity throughout history. And while that is the case, generally speaking, it doesn't have to be. You can have different types of central banks that interface very differently with the political system and the economic system and the population at large. I mean, if we're going to go down with this ship, which we would be if we were to stay with the fiat system to its natural conclusion, there are better ways to go down with this ship. People talk about like universal basic income, for example. Well, my opinion is that if you're going to be printing money to be bailing out banks that have issues with the internight loan liquidity, and with the banks that are going under because people are, because of bad loans that they made or overexposure to short-term treasury bonds or whatever, for every $1 that gets pumped into institutions, I believe there should be some equivalent amount of dollars that are distributed to the population at large, directly to the people. And, that is something that would be achievable. That is just a policy decision. And it might make the decision makers more conscientious around these decisions. Because if you think even back to COVID as an example, I can't remember the exact number, but I think it was something like there was $65,000 worth of debt per US citizen created during that period, right? So that's $65,000 per citizen. How much money did the citizens actually get out of that? Some of them got a $1,400 stimmy check, one of them got a $1,200 stimmy check. Some of them were on some basic job finding or welfare state income that would basically just keep them around or above the survival rate for what it means to be a modern human. And it's just wild, because if you deduct what they took compared to what was left, that all went to the banking and corporate institutions that fired them anyway. These companies were taking the money so that they could keep the jobs available, so that when the economy picked up again, you wouldn't have to have all of this restructuring, all these people that had been moved irregularly around the economy. I mean, you can have questions around, was that a good idea? But the point is, this money was just absorbed by the corporations. It went straight into the stock buybacks, and it went straight into the dividends distributions that the rest of the funds had been used previously, like the funds that they actually create organically. And so you have to look at this as just pure systemic corruption facilitated through centralization of the money supply and the distribution mechanisms. And these are things that can be changed even within the current system, even if we don't have a revolution to an asset-backed currency or a store value based digital financial system. There are things that we can do now that would fundamentally improve the quality of the economy, the quality of the experience of being a modern human for people all around the world.
Yeah. Well, that's the hope and the dream of decentralization. But yeah, today's world still looks very far away from achieving a dream. And you mentioned the Cantillon effect, which is an idea that has emerged fairly early in the development of Bitcoin. But it's still somehow hard to grasp. As I understand, thinking about at the financial system, the central bank sits at the top, and then you basically below the central bank, the commercial banks, they can borrow money from the central bank at relatively low interest rates, and then the businesses and the average person then goes to commercial bank and can borrow from them. And how does the Cantillon effect benefit those who are closer to the central bank? I mean, the average person cannot go to the central bank and borrow money from there. Is that the solution, or what's the exact problem? Commercial banks are sort of better off being close to the money supply.
Well, they're benefiting because they don't have to distribute the money. Like, they get to take out 0% interest loans, and they get to use that money for speculation, as opposed to investing in real world businesses, giving out loans to local entrepreneurs to be able to build out the general economy. They get to take out 0% loans, and they get to speculate, purchasing houses, which is why BlackRock and State Street have been acquiring so many houses, is that they have basically 0% interest loans. How the hell can anyone compete with that? If you have basically an unlimited credit line with 0% interest to the people that create the money, how the hell are you, as a local person who's working hard, who may even be successful in your regard, be able to compete with that? These guys have cash ad infinitum. They can just access what they want when they want, and that's really really an issue. And again, there's different stipulations that the central banks could put on the money, which is, we will give you access to the credit, but a certain amount of this has to be loaned out into the general economy, very low interest rates, much similar to the interest rates that we are giving you, and you get to make the small spread in between, because yes, you are a commercial bank, but we are choosing to let you have this credit facility. And if you're greedy, like you have displayed to be for decades, then we are going to cease to be so generous with our credit line, and you have to pump money through the system. Money is the blood of the economy, and the central banks and the banking institution, the financial system, is the beating heart. It's meant to push money around to the parts of the body that need it. That's the whole point. But what we're seeing is that instead of having that role and responsibility within the modern world, they're just collecting money and they're storing it for themselves, and they're looting the treasury at the expense of everybody else. And it's such a deep corruption that people don't even know that it's happening. There's so many flavors of corruption in the modern world, which can be traced back to the current construct of finance, that people are confused. They don't really see things in a systemic way. They get lost in the detail. And I think it's time for us to stop looking down at the detail and start looking up at the bigger structures.
So basically, what you're saying is they can arbitrage the low interest rates charged by the central bank and put their money anywhere where they can earn more interest and just pocket that money, and then they can just do this infinitely.
Yeah, effectively. To whatever extent the credit facility is from the central banks, which is obviously very generous because the system's based on debt, and so you need to keep printing minimum enough to keep the game of musical chairs going.
And all this seems so convenient. When I started to learn how easy it is to make money when you have money, just by buying basically index funds or invest in a diversified portfolio, or basically betting on the economy to grow, that there's almost like a risk-free way to get a return. I was mind blown. I thought there was investing had a tremendous risk, and investing can have a tremendous risk, but there are ways to do it which seem to be very, very low risk. And you just need a lot of capital. And if you don't have capital, then you're basically losing. Transitioning maybe to like the future role of money, maybe money that also cannot be corrupted. What is the solution to money? I always thought, like, okay, why do we have to even have money that at least a store of value while also being a unit of account? Why can we not have something where the money is, or basically the currency we use is just the unit of account? Because it seems like one of the hardest parts in decentralizing money seems to be the value aspect of it. Because as soon as you start putting some assets into a vault, it can be more easily manipulated. And there is also the urge to sort of mess around with it. If you would decouple that seems to, at least to me, like could be one of the option going forward. The problem seems more to be there is less of an incentive to create that money, because the other money seems to have just more benefits for those issuing and distributing that money.
Yeah, I mean, it's an interesting proposition, one that I'd have to reflect on, to be honest. But I mean, it makes sense that would be the adoption mechanism, is that early adopters want to propagate it so that they can benefit from the network effects and the price increases, assuming a limited supply. Regarding what I think of is the end state of money, if we're thinking, again, very long term, under the assumption of continued technological development and evolution. This is going to sound a little bit out there, but the best conclusion that I can come to is some kind of algorithmic stablecoin based on some primitive of the internet itself. Now, that could be something in the hardware layer, the stack, like the tech stack of the internet, or in the protocol layer of the internet. Because what we are assuming, like moving forward with what we're assuming with cryptocurrency in general is that there is an internet for there to be a cryptocurrency. Obviously, the cryptocurrency is an application built on top of the internet, if you think in those regards. And so we are already fundamentally dependent on the internet. And so my question is, isn't there something within the internet's tech stack that we could not just tangentially get value from, but directly get value from? And there's a few options that are available that could be viable. And, I've been thinking about it myself, but it's something that I want to be able to dive much more deeply into in the coming years. But it makes a lot of sense to me because, again, like we are already 100% dependent on the internet. We are already tangentially getting value. Is there something in it, in that tech stack, that we could peg value to and derive value directly from? And like a good metaphor for it is if you look in Kenya, for example, has an emergent local economy based on the M-Pesa, which is the phone credits for the local population. So they have to buy phone credits to give themselves access to internet and to internet data, and also just signal for phone calls and SMS. So they're actually building an economy based on that, because the assumption is they transact with M-Pesas, meaning that you have to have the M-Pesa to then trade the M-Pesa. So you have to have the M-Pesa to be able to use your phone to be able to trade the M-Pesa. And so in that sense, they have not only referentially derived value from that, because it's not like they're using their phone to have access to the internet to send themselves a PayPal transaction. No, they're actually using the unit of connection value, which in this case is the M-Pesa phone credit, as the medium of exchange and as the store of value. And I think it creates a very powerful pointer to what could be possible with actual internet, like the actual direct usage of some part of the tech stack of the internet as our end state in money.
As far as I understand, the M-Pesa story was mostly like there was no alternative to sending value over the internet in these countries, and they just like naturally used it. And also their local currencies may have not been the most stable ones. Also, had more inflation than the value of the M-Pesa credits in the telecom system depreciated. But in the end, it's still a highly centralized form of money, to understand. Where do you think we can find this thing that you were looking for in the internet? Like, because what you're describing to me, like Ether, would make a very good money based on what you described.
Yeah, I mean, the question is Ether, which is, is it Ether's value, which originally started off as proof of work and now has become proof of stake? Or is it something else which is more intrinsically connected? And by intrinsic, I mean, for example, you could have, the amount of storage data connected to the internet, the amount of power being consumed by devices on the internet. And I understand that that's a lot of the time what these proof of, these consensus algorithms are trying to do. But I still think that there's something that could be explored there, which I've got some details which I've kind of outlined to myself, but I won't go that deep into them. They're kind of at the embryonic stage of development, and I think to discuss them on the podcast, they at least need to be a fetus. So I'll defer that to the future once I've had a bit of time to really flesh it out. But it's the thing that makes me most curious. And obviously, I'm not overly invested in that future. In the meantime, I think there's a lot of things that we can do with the Ethereum ecosystem, with Ether as an asset, with various types of stablecoins that either exist or will be coming online in the coming years. But yeah, there's something in that possibility that make me wonder, in the same way that Bitcoin made me wonder in early 2014, like, okay, there's something here. When I was first starting to understand it, there's something here that I can't quite touch yet, but it's drawing me in. And that's the same when it comes to this proposition about the algorithmic stablecoin backed by the tech stack of the internet.
Maybe shifting a bit more to your current activities as a founder. You recently started a startup called Lucid. And can you tell us a little bit more about what Lucid is trying to solve?
Sure. So Lucid is what we describe as a modular hub enabling multi-chain DeFi. What I'd noticed by speaking to a lot of teams and founders is that there's a lot of DeFi projects that are successful on one or maybe two blockchains. And they want to be able to grow into all these emerging L2 and L3 ecosystems that are coming online. But because of the complexity and the uncertainty involved in that process, they're tending not to make that leap forward. And so what I'm trying to do is bring together various solutions in the form of modules that can abstract away that complexity, minimize that uncertainty, allow the teams to be more aggressive in their growth plans, and then help them manage at scale. So we have a few modules on the platform. We have primary modules and we have secondary modules. The three main modules that we have is one, our bonding engine, which is a way for the project to bootstrap liquidity inside DEXs and TVL inside contracts on a new chain when they arrive. So they may specify that they want to have $200,000 of liquidity inside this LP pool, inside this DEX on this chain. And they want to have $300,000 of supply side liquidity inside these lending markets on this new chain. And through the bonding engine, they create an incentive structure by discounting their governance token to get the community to interact in these certain ways with their project, with their protocol. And then in exchange, they get access to those discounted governance tokens. The reason that's powerful is that the worst thing that can happen for a project is that they arrive at a new chain and they may have been successful on previous ecosystems, but in this new one, they're just not getting enough traction and people aren't adding liquidity, they're not adding TVL. and the project effectively looks dead, which is a really terrible indictment of the whole project. Again, even if they were healthy in other ecosystems. And through the bonding engine, you can effectively completely remove that uncertainty, because if 2% discount on the governance token was not a big enough motivation for the community to do what you want them to, then you can change that to 3%, 4%, 5%. And at some point, you will always find a market whereby the discount is motivating. And it's a way for the community to have access to these discounted governance tokens. And it's a way for you to be able to grow with confidence. So that's our bonding engine. The other two modules are the multi-vote and multi-bridge modules. These are for the second stage. So stage one is to bootstrap liquidity and TVL on the new chain. Stage two is to manage its scale. So the multi-vote module allows you to vote on-chain, cross-chain from any L2 or any L3 down to one base chain with a governor contract. So we connect all the L2s and all the L3s with on-chain governance. We rely on bridges, but we are totally bridge agnostic. So the project themselves get to choose which bridges they want the community to use. So we're not forcing anything on them because obviously there's a lot of security assumptions with each of these systems. We're saying we're going to integrate all the major bridges. When you're configuring your project, you select which bridges you want. Those will be available to your community as and when they go to make those governance contributions. As well as that, we also have quadratic voting integrated, and we have Gitcoin passport integrated for Sybil resistance. So now for the first time, you can have on-chain, cross-chain, quadratic voting with Sybil resistance from any L2 or any L3. This is the most powerful governance infrastructure that's ever existed in Web3. And we're very excited about the prospects of what this means. I understand that there's limitations right now in the desire for projects to go on-chain because, to be fair to Snapshot, they built such an effective system for off-chain governance. But for me, as the coming decade approaches, as cryptocurrency fulfills its prophecy of rebuilding the financial models of the past, there will be so much money flooding the system that you need to have minimum viable trust assumptions. And the only way to do that is with on-chain governance. And so we're building for that future because that future is coming, and it's something that we want to be ready for and that we can help shape and mold and also expedite. If we can build this ahead of the flood of requirements, of necessities, then maybe we can expedite it by a couple months, maybe a couple years. Let's see. So that's the multi-vote module. Then we have the multi-bridge module, which was actually inspired by Aave v4. In their v4 architecture, they described the issue whereby they would have a vote on one chain, let's say it's Ethereum, and in that vote was all of the smart contract changes that needed to be made across all of their ecosystems. And they had to be reliant on one trusted bridge to communicate those proposal instructions. And obviously, in a decentralized system and a decentralized world, one trusted bridge has its issues. One is that the bridge can be compromised, as in it could be hacked. Or secondly, it could just be down. In both situations, you're vulnerable and also basically rendered completely stuck as an ecosystem, that you can't move assets or messages between anywhere. And so in their new architecture, they describe a system whereby instead of trusting one bridge to communicate those proposal instructions, they're actually going to have 3 trusted bridges that they communicate those instructions through to each ecosystem. And on the receiving end is a message verification system. And when the same message has been received through 2 different bridges, only then can the smart contracts be updated or upgraded. So that means you're increasing your bridge security by orders of magnitude, because now at least 2 of the bridges have to be compromised at the same time. And also you're able to circumvent any bridge that's down or compromised. And so you can continue to function in that eventuality. So this was an amazing leap forward in cross-chain and multi-chain security that was presented by Aave. The problem is that they were building it for themselves and obviously not for the rest of the industry. And so we took inspiration from that and we built the same model with a few more security precautions, and we have democratized access to it. So now everyone who's a DeFi project can have access to a architecture that is as good as, but in reality, slightly better than, Aave, with zero upfront cost and with instant usage. The platform will be available in around 6 weeks' time. We've already got around $300 million of assets that we will be securing. These are projects that are very excited to work with us. Not only have they signed the contracts, but they've also actually invested in the company, which is very encouraging. So in that sense, the multi-bridge module and the multi-vote module can work seamlessly together, because you can create these proposals via the multi-bridge module where you specify the chains you want to target these contract changes to. You choose the bridges that you want to leverage. You set the consensus threshold, which we recommend to be 2 of 3, but it could also be 3 of 3. You push that live. The community can then vote on that from NEL2 or NEL3. If the proposal is successful, then we will relay those vote instructions, those proposal instructions back to those voting chains through the multi-bridge module, which is the most secure bridging infrastructure available. There's 2 more things I want to mention about that. One is that this is actually not only compatible with on-chain governance, we've also made it compatible with Snapshot. So you can fill in these proposals, you can fill in these smart contract instructions, upgrades, calls, whatever. You can choose your bridges, choose your chains, and choose your thresholds. You can then export that raw transaction data to the OSNAP integration on Snapshot. What that means is that when that proposal successfully passes on Snapshot, the OSNAP Oracle recognizes that, and then it triggers the raw transaction data included in the proposal, meaning that all those small contract calls will be relayed from the off-chain governance to on-chain deployment via our multi-bridge module. So it's very exciting because it means that now any project on Snapshot can credibly claim to be more decentralized, more transparent, and more autonomous than any other by use of the multi-bridge module. The final thing I'll say is that we've actually made this compatible with asset bridging as well. So if a project wants to move large volumes of its governance token from chain A to chain B, that will be entirely possible through leveraging the multi-bridge module, meaning that they can burn the tokens on chain A and mint the tokens on chain B if it's an ERC20 token. All of those mint and burn messages are relayed through the multi-bridge module, as I mentioned. But also, it means that if the tokens are non-ERC20 compatible, instead of burning them on chain A, you can lock them on chain A and mint them on chain B. It's a way of moving large volumes of liquidity from one chain to another with the least risk assumptions of the industry. And again, this works incredibly well, especially at high volumes. So that's very exciting.
Yeah, well, there's a lot to unpack here. But yeah, I definitely see the need for such a solution. I mean, we at 1delta have slightly different needs because we don't have our own liquidity, but we definitely understand the overall trend towards being available on multiple chains. Also around the whole term of like chain abstraction. But maybe let's go through the different modules one by one to better understand what's going on there. So you started with the bonding engine. As I understand, this is just one part of like helping to bootstrap liquidity or bring liquidity to new chains where someone just recently or a project recently deployed on. How is it different to previous sort of incentive mechanisms like liquidity mining?
Yeah, so liquidity mining was the initial way for bootstrapping liquidity inside DEXs back in the summer of 2021. The idea being the project would create a LP pool inside of a DEX. They would then say, if you go and get these LP tokens by adding liquidity, you can then lock those tokens into this mechanism. When you do that, we will print you governance tokens, which then you can either keep or you can sell. And that was a way for the project to bootstrap liquidity. And when it's got liquidity, obviously it can trade without having too much of a price impact. And that's very important. The problem being that these projects were having to print extremely large volumes of tokens to be able to attract that liquidity because it very quickly became overly competitive. And within a couple of days, the tokenomics of the projects were completely screwed up because they'd printed way too many tokens. These tokens had then also all been dumped on the market. So, I mean, and then once that happened, once the APRs of the tokens and the price chart of the token had collapsed, then people would take that liquidity and go elsewhere anyway. And so the project had crap tokenomics, a crap price chart, and it had no liquidity. And it was really a very it was kind of a dark period, I suppose, in many ways of the development of tokenomics and liquidity provision. But out of that came Olympus DAO with the idea of protocol owned liquidity as opposed to protocol rented liquidity. And this was a very powerful shift for them. They had two core innovations. One was protocol owned liquidity. One was the 3-3 tokenomics. To a large extent, the 3-3 tokenomics was proven to not be a very robust nor legitimate innovation. And that's why the price has collapsed since then. And so I ask you kindly, do not conflate the innovation of protocol and liquidity and its quality with the innovation of the 3-3 tokenomics. These are not the same things. And so the idea of protocol and liquidity is, instead of renting the liquidity from the community, why don't we actually purchase it? Whereby, instead of constantly printing new tokens for you locking in these LP positions, why don't we make a one-time sale where you give us the LP position, you give us the LP tokens, we now own them directly in our treasury, meaning that we're diversifying our treasury as we go, because a lot of these stablecoins are half denominated stablecoins. These are revenue generating assets because that's the nature of an LP token. And this is lasting liquidity that will be there for as long as we want it to be, until we make the decision to rebalance out to other assets or whatever. So that was an innovation that was brought forward by Olympus DAO. It was extremely effective, so effective, in fact, that it still has one of the biggest treasuries of today, even though their token and their project have basically died. That's because they're constantly diversifying the treasury as the project is picking up momentum. So that was Olympus DAO, which was, again, they were innovating for themselves. Whereas then they tried to build kind of like a product whereby it was more of a service that they were giving to other projects, and they were trying to make money from that. That wasn't massively successful, but it also birthed something called the bond protocol, which was much more advanced. And that was kind of the latest stage of innovation for that cycle with this technology, where they would have different types of bonds, and they would have different strategies for the sale of the bonds, and they accepted multiple collateral types, and etc. So that's where that went, and that kind of was where the 2021-2022 cycle ended off. And the problem was, firstly, that the market completely went out from underneath the ecosystem. Secondly, unfortunately, the bond protocol was hacked. And also, I think that because of the state of the market, there wasn't much attention paid into continued innovation. So that's where the story somewhat ended. But for me, it wasn't really, because it was still something that I was mind blown wasn't more widely adopted and more widely appreciated, because there are still so many projects that have such incredibly high exposure to their own token in their treasury. 99% exposure, even in the hundreds of millions or billions of dollars of just their token. Yet they have basically no on-chain liquidity. They have markets, if it's a lending protocol, that are massively underperforming, and they could so easily redistribute these governance tokens that they have lying around into these investments, into their own protocol, and have these investments pay dividends, both in the fact that they're revenue generating assets, but also in how that affects the perceptions of the project. So that was where I started picking up with the idea and started to think, okay, maybe there's more here than people perceive. And that's what brought me to bringing together the bonding engine, where we took a similar principle as the bond protocol, made many improvements on top of it. Like, for example, we made it compatible with Uniswap v3 through integration with automated liquidity managers. We added full Oracle support from Uniswap and also Chainlink. We're going to do very thorough auditing on these modules. We're driving the TVL bond as like a new phenomena, which I really think is something that's completely untapped. We're making these bonds compatible with any L2 or any L3, whereas before, they were only centralized in like a couple of chains. So if you want to go to some abstract L2 or 3 or just something that's new and hot, you can deploy the bonding engine there and you can draw liquidity to you and to that ecosystem through leveraging it. And finally, we put it on a feature-rich platform. So therefore, it can be used to support the journey of the projects from the same interface, from the same from the same place where people are familiar, as opposed to being kind of stuck off in some corner of the ecosystem where people barely know about you. And so through that, we think that we can really affect change in the space of liquidity provision. We also don't think that it's a one-to-one supplement for the liquidity mining programs that have been prominent over the last year. If you look at Gauntlet's recent research report, where they even as the smartest guys in the room when it comes to DeFi risk management, they also see that protocol owned liquidity as a very valuable place alongside liquidity mining. And so when I'm speaking to these clients that we're signing, and some of them are the biggest clients in the industry, I'm saying, yes, you need the bonding engine, but you also need to be able to support yourselves through some liquidity mining incentives as well. Have both sit alongside each other. They complement each other very well, and do not fall under the trap. The protocol and liquidity is something that can be passed away and something that's dead to history. It will have a resurgence, and it is having a resurgence. And again, it's better to front run a trend than to be the last one to follow.
This bonding engine enables protocol-owned liquidity. How is it different to just raising more money, putting it into treasury or user treasury basically to provide liquidity?
Yeah, I mean, it's not necessarily a new way of raising funds for the project. It's a way of investing your own governance token more effectively within your own ecosystem to produce the outcomes that you want. As I mentioned, these projects are sat with, tens, hundreds, billions of dollars of their own governance tokens, which are non-productive assets. They're just sat there on the balance sheet, massively exposing them to the risks and the movements of the market. And what's been seen over the last couple of months is this was a very bad decision. Now the question is, could they have done something better? I think by having revenue generating assets, which could be LP positions, it could be yield-based assets from the lending markets, for example. Like if you look at Aave's treasury, you'll see that they've actually started migrating from having full exposure to Aave to now having a more distributed collection of tokens, including AUSDC. So they're actually owning their own AUSDC, which are revenue generating assets, which are diversifying the treasury, yet are still inside the Aave ecosystem. So it's hard then for the community to say, you're just going to be holding USDC, or you're taking the money to sell it in exchange for T-bills, which you're going to hold in treasury accounts and earn passive income. No, it's none of that. You're keeping it within your own economy, at least with the TVL bond, but you're diversifying. You're diversifying and you're adding to it in ways that are strategically important, especially if you have markets with low liquidity, if you have LP pools with low liquidity. Again, it's just not healthy, and we should be reevaluating how this looks for health and long-term viability. Even if you do have to make some difficult treasury decisions, even if the community are not going to appreciate it massively in the beginning, it is in their best interest to have these markets, these LP pools fully diversified, having met the minimum required levels to give both the perception of growth and the perception of health to the community, but also to allow the operations and allow the protocols to function at their most optimal.
Okay, switching to the next module. As far as I understand, the bonding engine is something you can use, but you don't have to use as a tool. To bring a project like a lending protocol, for instance, to multiple chains, governance across the multiple networks is something that is not being done too often yet. How hard is it to migrate from an existing solution like Snapshot?
Yeah, it's a good question. And ultimately, it comes down to the complexity of the tokenomic model of the project. Some projects are very complex when it comes to like they have VE models or they have different staking reward models. And right now, with the limitations of on-chain governance, it is more difficult. And so that's why I don't blame projects for sticking with Snapshot, even if they have high treasuries. But with the infrastructure that we currently have, we've taken the governor contract, the Bravo governor contract that was originally created by Compound, then it was maintained by Open Zeppelin. It's had some work done on it to do something called flexible voting by another team. And so we've taken that principle and we've implemented it so that we can make it compatible with quadratic voting with symbol resistance, for example. You can do different time-weighted voting as well through this. There's much more flexibility through our version than there is through traditional versions. But there's still room to grow. This is one of the places that I want to take Lucid over the coming 12 months, is that now we're wrapping up our beta and we're getting some great traction from some very big projects. The modules that are getting the most interest are the bonding engine and also the multi-bridge module, because that's compatible with Snapshot. That's totally fine by me. I mean, it's obviously very exciting that even one of the modules is getting the kind of traction that we're getting. But for me, as a passion project, is looking again decades into the future, we need on-chain governance and it needs to be better. And I'm fed up of waiting for other people to make it better. With the current version of the bonding engine, that is pretty much complete. There may be some things that we could do to optimize it, but as a product, I mean, what we're delivering is by far the best that has existed. And I struggle to see how we can make it massively greater than what we already have. With the multi-bridge module, it is extremely impressive what we've been able to do in that regard. And there will be improvements, but again, we've kind of already shifted through this big leap of innovation that we're bringing to people. And so the place that I'm most excited to investigate going forward, where I think there's much more possibility, although very complex, is on-chain governance. My dream is that you can have the flexibility of Snapshot with the trustlessness of on-chain governance. And once you can crack that nut, and it is a nut that I believe can be cracked, then it opens up tremendous possibility. And especially when you're talking about gasless on-chain voting, which is going to be increasingly possible through various mechanisms and through decreasing transaction costs on L2s, L3s, and even Ethereum. I think if you can have gasless, on-chain, cross-chain voting with complex tokenomic models, then I think it's the obvious choice for projects, especially as more money floods into the system, especially as crypto rails start to replace traditional rails. And so it's something that I personally vouch for and pledge my allegiance to, is to improve on-chain governance.
Or where do you see the challenges in bringing this multi-chain governance to life? I mean, as far as I understand, sort of this is like like a hub that is the backbone that is bringing together the different deployments when it comes to like different smart contracts and different networks, and being that governance backbone that managing all the different deployments across the different chains. Many cases are even far behind, like enabling this on a single chain, and sometimes also it seems to be just a lack of incentives. Where do you see the biggest challenges in adopting this, and how is it also impacting potentially like the end user and token holder having such a solution in place?
Yeah, I think, as I mentioned, the biggest issues are firstly onboarding the projects due to the lack of flexibility with what you can actually do with the models that you can leverage. So that's the first thing. Secondly, users don't want to have to pay for on-chain governance. That's the second thing, and that's totally fair enough. Thirdly, projects have to trust bridges, and bridges, unfortunately, are not that trustworthy. If you look at most of the major hacks that have happened in the last few years, the vast majority have happened through bridges. whether it was compromised multi-sigs or relayers or, all these different attack vectors. It is a problem. It is a problem. So I think what we're trying to do with the flexibility through flexible voting strategies, as I mentioned, through being able to promote gasless transactions, which again will be coming as part of the next version of Lucid. These are all very powerful contributions to the space, and I think that in the medium to long term, this will really bear fruit. And so that's why we'll be investing heavily in it. In terms of what it means to not have it is pretty obvious. If you're going to have expensive transactions for governance, even on one chain, but you have deployments over 5 chains, essentially what you're doing is you're creating second-class citizens within your economy. The first-class citizens can vote, although they have to pay. The second ones, that even if they're willing to pay, they're not able to. They're just completely second-class. Their opinions are irrelevant. This is a problem for communities, and this is a problem for projects that want to foster a healthy collective where people feel valued. Their diverse opinions are being taken in, they're being considered, they're being filtered, they're being voted on, and then they're implemented. Like, without having this as like a base fundamental, like this is the base of the hierarchy, can they even participate? If they can't even participate, then the rest of the hierarchy of the health of the community does not matter. And so that's really a fundamental with regards to that. In terms of other issues surrounding voting, like voter apathy and incentives programs, these are still open questions that need to be investigated. I think we need to make governance great again without being too cringe. Like Lucid actually originally started out as a governance-based project, but the problem was the investor appetite for funding these projects was completely non-existent. We built, in my opinion, and I think is fair to say, the most advanced governance platform that Web3 had seen. And I showed it to a bunch of tier 1 VCs, and they said, this is amazing. We're really impressed by the quality of your insight, the quality of your execution, and the amount of traction you've been able to get. But governance is dead, so either come back in 2 years or pivot. And that was a very painful pill to swallow for us because, it felt very unfair, especially when you start thinking about the implications of what it would mean to have an optimized governance infrastructure for the future of finance, for the future of the value, the insight of value. But actually, in our specific case, it was one of the best things that's happened to us because it forced us to rethink the model of Lucid. And what we came up with was this modular hub to enable multi-chain DeFi. It had a governance component, but it extended far beyond that. It was able to be much more of a comprehensive support infrastructure for these DeFi teams. And ultimately, I'm in blockchain because I think DeFi is the killer application of blockchain technology. And to be able to help them so directly and now getting the feedback that we're getting, which is honestly incredible, those rejections really open a door for us to evolve and to potentially contribute in a big way.
So how does Lucid help to reduce the cost of voting for the smaller token holders?
Well, right now we do that by allowing them to vote from NEL2 or NEL3, bridge their tokens or purchase tokens on other chains, which is cheaper than the L1, although I have to say the L1 has got significantly cheaper in recent months. So that's really where that is. And as I mentioned, we haven't built the gasless infrastructure yet, but the multi-vote module is where I'm planning to spend the most of the time in the coming year, doing all these innovations that have not yet been achieved. What we have built is very advanced. I mean, having cross-chain, on-chain quadratic voting with civil resistance from NEL2 or NEL3 via any bridge is some serious innovation. That's a serious step forward, but it's not enough. I mean, I'm not going to pretend that it's seismic and that it's going to affect change all across Web3 and outside of Web3. But I've been able to deliver on the first stage, and the second stage is what I just described, and that will be coming over the next couple of months. And I'm excited to be able to come back and talk about that in the future.
Yeah, we can definitely do another recording once some of these ideas have a bit more flesh. Also, coming back to the idea of the future currency. The third module, and seemingly for me, at least from my perspective, the most important one is the one that enables cross-chain liquidity. Can you dive a bit more into the inner workings of this module and what kind of standard it is using to enable that?
Yeah, sure. So the multi-bridge module was, as I mentioned, modeled on RVD4 based on the necessity to securely transmit vote instructions and smart contract instructions to their various ecosystems. So that was where it was born. We realized recently, actually, that this model, combined with the XERC20 standards, would allow for high volume asset transfers from chain to chain with the lowest risk available in the space. So let me dive into what that actually means. So firstly, the XERC20 standard is a standard whereby instead of relying on bridges to bridge, instead of relying on bridges to move assets from one chain to another, and then on the receiving chain, you have a wrapped version of that original asset, which is tied intrinsically to that bridge, which gives you all of the bridge exposure associated with that wrapping process, with the various attack vectors for that bridge. The XERC20 standard allows a token on chain A to be natively burnt on that chain and then natively minted on the receiving chain. The only thing that was being passed between those two bridges was not assets themselves, but a message. And that message mediated between the mint and burn function. So this was a standard that was originally in EIP. It was pushed for and propagated largely by Connext. And now there's different versions of that standard that have been adopted across all the different bridges in the space, essentially. The problem with those other ones outside of Connext is that they try to lock you in to their version of the XERC20 standard. Originally, it was meant to be a pure implementation where you can mint via one bridge on one chain and you can go one way and then you can come back through another chain and it's all the same standard, so it doesn't really matter. That was the original, but obviously that doesn't really align with the incentives of modern corporations. And so they all create their own standard where they try to lock you in and get their BD guys to sign contracts. So the first thing that we've done is that we have removed that as a option. You can, through Lucid, through some standards that we created, you can use the XERC20 standard through any bridge you want. You want to go from chain A to chain B via layer 0, and you want to return via Hyperlane or CCIP, you can do that. There is no vendor lock-in. We have invented our own standards whereby you can do that however you please. And so that's the first innovation, is that through us, you get access to all of the bridges that you choose. Obviously, you don't have to choose them all if you don't want to. It's just there as a possibility, which is exciting. And then secondly, for large transfers, you can then rely on the multi-bridge module to communicate these mint and burn function messages for you. So that's the 2 of 3 multi-bridge consensus that I mentioned. So you can say, for example, burn $10 million of tokens on chain A, mint those tokens natively on chain B, and because it passed a certain threshold that you set when you were creating the organization on Lucid, because of that, you have to use the multi-bridge module, and now effectively you send that mint and burn function message through those 3 bridges. Once the 2 of 3 consensus has been met, the tokens are minted on the receiving chain. And so this is amazing for really large volumes of asset transfers where you don't want to be dependent on one bridge and you don't want to have wrapped assets on the receiving end. So this is, again, like extremely powerful. You can have native assets on every chain, which if you're moving high volumes of, you have to use the multi-bridge. That's just how you've configured it. And so that's there as a possibility. But you as a retail user, if you want to go and move your funds between bridges and you don't want to go through the multi-bridge module, that's fine. There's a lower tier, like a lower amount of tokens that you can move, and you can move them through any bridge you want. So if you want to move them by layer 0, that's your preference. If you want to move it through Hyperlane, that's your preference. Whatever you want. you have now got a token which is compatible with all those bridges across all these chains. And you can go and you can do that either through our interface or through another interface. Like if you want to go to layer zero's interface, that's fine. Just through our contracts, you've been whitelisted and you can do that. So we're excited by what this means. The reason we came up with it is that we told projects about the multi-bridge module, and there was one project that I spoke to that said, can you enable it for asset transfers? Because if you can, I will get them to integrate this immediately, because this is a real problem. We don't want to be reliant on one bridge for having all of these wrapped assets on one chain. We don't want to be doing large volumes of transactions, like large volume transactions at one time. We investigated it and we're very excited to find out that this was not only achievable, but something that now, as of today, something we've implemented.
You mentioned Aave V4 and share liquidity. What kind of use cases does it enable? Because, I mean, DeFi is a broad space. Like the obvious ones are like the lending protocols that could certainly benefit from share liquidity. Can you talk a bit more about the popular use cases that you're seeing where this module can be used?
Yeah, so for now, the module is used for message relaying cross-chain. So that's either by snapshot or by on-chain governance. And the second stage will be for it to be fully compatible with governance token transfers, even in large volumes. So it's right now, that's what we're looking at. We're looking at governance tokens, and we're looking at messages. At some point, we will be looking to extend that as some shared liquidity layer for any tokens produced by the project. So, if, in the case of Aave, if you had AUSDC, you wanted to migrate liquidity over to another chain, then that's something that we will be looking to implement in V2, or at least in the main release of Lucid. But for now, these are two great contributions in the space of bridging, the message relaying, the governance token rebalancing cross-chain. These are two huge markets. And so we're happy with those contributions now. And in terms of going forwards, the sky's the limit. And we'll do some more raw innovation there too.
So this share liquidity, like in how Aave conceives this for version 4, is only going to be available in the next version of Lucid. Well, what are the challenges in implementing that? And also, what are the challenges for a project to enable share liquidity?
So in terms of implementation, it's actually extremely easy. They would just come to Lucid and they would, their organization, they would choose the bridges that they wanted to allow compatibility with. They would set their mint and burn limits for those bridges, as I mentioned. And they would do those token deployments either with a new token or with an existing token. Either or, we can support both. The benefits with the new token is that it will be XERC 2020 by default if it's produced through Lucid, meaning that you can mint and burn native assets across all these chains with no limitations. If it's an imported token which isn't XERC 20, when you're in theory burning a token on chain A, you're not actually burning it, you're locking it, so that token will always be there for redemption at some point in the future. It's still a very effective system, but it's not the ideal or pure version or pure theory of what XERC 20 was meant to be. But yeah, you do those configurations, you do that deployment via the Lucid no-code UI. Once that's done, all you have to do then is, if your token has on-chain governance, then you have to pass a vote, which includes the smart contract instructions to pass over smart contract calls and upgrades to our bridge module, essentially. So like the multi-bridge module obviously needs to be able to tell those smart contracts that changes are needed. So you just have one contract call. You have like one contract upgrade to change the authority of who can tell the contracts to upgrade or change or to trigger stuff or whatever. So that would be one governance proposal to make the migration. Alternatively, if you don't have on-chain governance, then you can just use the safe transaction builder to be able to go in and make that change. And so effectively, it's a no-code change, which if it's on-chain governance dependent, will be one vote. And if it's not on-chain governance, it will take them, a couple of minutes maximum to change the address and then sign the multi-sig. So it's actually extraordinarily easy to move to this, and that was the whole intention. That's why we have a no-code UI. So we're excited to get this in the hands of projects. We will be launching just after DevCon, so middle of November. We'll be launching, as I said, we have around $300 million of TVL / secured assets that we will be launching with. And so we're excited to get this going.
Where should I go as a founder who is interested in your solution?
Where should you go? You should go to our Twitter page, which is at Lucid Labs Fi. As I mentioned, we will be launching in the middle of November. We're going to audit in 20 days. So now we're in that final phase of development, optimizing everything, get everything ready. Once we are launching, we will be sure to inform people via the Twitter. We are going to be doing a lot of co-marketing with the projects that we are either partnered with or that we are using. So you should see a lot of attention moving in our direction around the time of DevCon. We'll also be sponsoring some events. So if you're in DevCon in November, make sure to keep your eye out for Lucid sponsored events where you can come and meet me personally.
Amazing. Well, thank you so much for not only coming on, but also for building the decentralized future.
Perfect. And thank you so much, Kevin. And right back at you. I hope both of our projects become fundamental pillars of the future that we all deserve.